Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to the Think Realty webinar. Today we have a special treat. We have Joel Jensen with Tax Sentry with us, and he's going to talk about tax strategies for real estate investors. One quick reminder, if you have any questions, on the little bar on the right, you'll see a questions tab. Just throughout the webinar, if a question pops in your head, just put it in that questions bar. And then once the presentation's over, Joel will try to get to as many of those questions as possible. So put those in there. With that, we'll just bring Joel on and get him going. Good afternoon, Joel.
Good afternoon. Thanks for having me. I appreciate it. Thanks to all of you that are joining us to talk a little bit about tax and tax structuring, ways to reduce our dreaded payments to our lovely IRS partners that we all have and everything that we do. We want to talk about tax structure a little bit, but first, because of the recent events that are going on through the economy and are affecting all of us, I just wanted to take a few minutes to go through the stimulus bill. This will be a pretty quick revision of what's going on. But the economic impact payments, I get tons and tons of questions on these that my clients are emailing me. Just to go over it really quickly, it's a $1,200 payment per person, $2,400 for couples, $500 for each child. And that child is up to 16 years old, by the way. Kind of follows the child tax credits. But look for those. There are some income phase-out limits. If the IRS has your information from your 2018 tax return as far as bank accounts go, I am seeing electronic deposits starting, I guess. The first ones I saw were roughly about a week ago. So that is going out. If they don't, then they can mail you a check. But the information is based off of either your 2018 or if you file 2019, your 2019 tax return. Now, if you didn't file either one, so let's say you were just in one of those situations where it wasn't required of you to file, you can still receive the payment. And the way to do that is to go to the IRS's website. I kind of detailed some of those things out right here. But go to irs.gov, and then you'll see this Get Coronavirus Tax Relief button. It'll be the second one on the left-hand side. If you click on that, you can follow the prompts to the Get My Payment box. And that's where you would check on the status of your payment, what they have information-wise for you, and the ability to upload information to them if you didn't file for 2018 or 19. A couple other ideas when it comes to the stimulus bill. Now, because of the economy, a lot of people aren't working at the moment. Some people may be in need of funds. The IRS did unlock the 401k dollars for many of us. So it used to be that we could get a loan for $50,000. It's up to $100,000 at the moment. And you can get a distribution without that penalty based on, as they put at the bottom, adverse financial consequences due to the pandemic. What that is isn't exactly defined at the moment, but if you've been, I would imagine if you've been furloughed, lost your job, and now you're having trouble paying rent, those types of things, you can get a distribution. It is taxable, but you don't get the penalty, but you do have the ability to pay that back over a 3-year period. And if you do that, then there's no tax on that distribution. So it's another way to unlock funds if you need them. A few other items in relation to this stimulus bill is, first, if you have student loan payments, and the reason I put this in there is because so many of us have student loan payments. Those are deferred now through September 30th. It's not something you have to go in and account for or submit for. It's automatic, so you won't have payments now until October. The Paycheck Protection Program, often referred to simply as PPP, is an SBA loan for those people trying to keep employees. So it's an employee-based loan. There is a forgiveness portion that can be obtained through that loan based on how you use the money, and there are rules associated with that. But don't go to the SBA for that type of loan. Actually go to an SBA lender, which in most cases would be a bank. There are lots of other places you can go, like Lendio.com is another one. If you're having difficulty with your bank and you have employees and you're trying to keep the money to pay them, it's another place you can go. And lastly, the economic injury disaster loan, also if you've been affected as far as a business goes from what's been going on with the economy, it's another place to go get funds to help out, to keep employees on, to keep the economy moving, to pay some bills. It's another great way to do it. Okay, so that was a really quick rundown of the stimulus, but let's get to the reason we're all here, which is the Tax Cut Jobs Act. It's a way to try and reduce the money that we owe based on the money that we make. Now, I want to give you a scenario really quickly, if I can, a story about kind of what's happening with and what I'm seeing with some of my tax clients. And I'm going to mention two of them. Okay, first one, his name is Michael. He's a scientist, lives in Los Angeles. And when he sends me his tax information, it is exactly the same every year. I mean, exactly the same. He is a scientist, right? So every T is crossed, I is dotted, exactly the same. So I know what I'm getting. So when he sends me information, I get on the phone with him. We start discussing it, going through it. I say, okay, Michael, let me go and I'm going to complete your tax return. I'm going to send it to you. Then we got to go through it. So I can update you on any of the rules that have changed and what's been going on with the tax code. So when I do that, I send it to him. We get on the phone, and typically, as most people do, they want to go straight to the refund or what I owe page, right? Skipping everything in between. And for me, everything in between is really where all the good stuff happens. But anyways, we get to that second page and go down to the bottom, and he is getting, now, mind you, he is getting a tax refund of $10,000. Now, most people would be fairly happy with $10,000 going back into their pocket, pay for maybe a trip somewhere, a little vacation, get out of some debt. But his reaction to me was, that's it. That's all. That's all I'm getting is $10,000. I said, well, Michael, now let's go through and let's compare apples to apples, not apples to oranges, see what your withholdings are, see how they compare to the prior year, what your tax rate is, some of your deductions. So we go through all the in-between stuff that he wanted to skip. And we look and see that actually he had fared better last year than he had the prior year. Now let's take account to another tax client that I have. Her name is Jen. She lives in Texas. She's a real estate person. She has a bunch of rentals. She sold 3 rentals last year, 3 properties. And she had got a hold of me early in the year, right? So we were able to do some tax planning around the sale, how to structure the sale, what to do with the money, some expenses that she could incur, just in an effort to reduce the amount of tax that she would owe on those 3 sales. And when she got to the end of the year, sent me her information, we get on the phone, we start going back and forth. I say, okay, let me go through it all now that we have our actual hard numbers. And I'm going to get back to you as soon as the tax return is done. After it was finished, send that out to her. We get back on the phone and we go through everything, get to that bottom of that second page for refund or amount due. And she owes $60,000 to the IRS. Now, before you say, oh my goodness, just realize she made a lot of money to owe that $60,000. But her reaction to me at the time was, that's it. That's all I owe. Same reaction, very different scenarios, right? So what does that tell me about tax returns and people's kind of relationship with tax returns? Is that when you do yours and get down to that second page on whether you owe or getting a refund, it is all based on your expectations. What are your expectations when it comes to your tax return? Do you know? Or are you the type of person that sits down with someone like me once a year, like right now, for example, maybe we do a Zoom call, but let's say we Zoom call, we sit down, we start going through information, and you say, hey, Joel, how can I reduce my taxes for last year? My response first would be, how come you weren't talking to me last year, right? Because it's based on expectations. If you know where you are throughout the year, the money that you're earning, the expenses that you have, the tax bracket that you're in, how we can tax plan around things. When it comes to actually doing the tax return, we're talking about simply complying with the law, right? It's just compliance. That's all it is. So I want, for the few minutes that I have you with me today, is to maybe change your mindset when it comes to taxes and your tax return. Navigate what your expectations are actually going to be. So when your tax return is done, there's no stress over it. You're not, you're not getting something that you're not anticipating because you know where you're actually at. And it starts with these tax rates, and that's what you see before you. Now, you may say this is the most boring slide I've ever seen. It just shows a bunch of numbers and some tax rates. Yeah, who cares? There's nothing to do about this particular page. But let me tell you something. There is a lot that's going on here. And there's 2 sides to this little coin. I'm going to tell you what they are right now. And this becomes a mindset issue for everyone. Let's say you won the lotto tomorrow. Oh, you'd be pretty happy. Let's say you won $100 million, okay? Enormous lotto. So you say, oh, my life is going to change. I'm going to go buy a bunch of real estate, right? But did you actually get $100 million? I mean, is that actually what you're going to get? Because that's how it's portrayed. That's what you think. That's what your mindset is. But it's not. What's really going to happen is first you're going to take the cash option. That's going to reduce it by about 45%. And then you're going to get taxed, depending on where you live, up to 45%. So maybe when you say, oh, I just won a $100 million lotto, you're actually left with about $35 million, right? What happens when I sell a real estate property? And let's say I flip something, I make $100,000 off of that flip. In your mind, are you saying I just made 100 grand? Or are you realizing what your tax rate is? And off of that 100 grand, you may be saying, really, I made 75,000, right? Because I have a partner that's interjected with all of these things that I'm doing, which is the IRS and sometimes my state. Okay, well, we're going to talk specific about the IRS right now. So you have to understand when I'm making money, what am I actually making? And that depends on the tax rate that I'm in. Now let's flip the script a little bit. Let's go to the flip side. What about when I spend money? Okay, so before all this stuff happened with the pandemic and, you know, I had the shelter in place and all those types of things, I went to an Apple store. It's been a couple months now, right? And I saw, ooh, look at this little new technology. iPhone 11 Pro, oh, it's a beauty. $1,400 for this thing. $1,400. Said to myself, wow, that's really expensive for a phone, right? But then I remembered, oh, but I'm gonna be using this for my business. That phone's on sale for me. What's my tax rate? 25%, 35%? I'm getting a 25% discount on this phone. Apple never puts their stuff on sale, but because I'm buying for my business, of course it's on sale for me. So you may go buy an iPhone for $1,400, but I'm only going to spend $1,000 because the IRS is going to cover the other $400 for me, right? So on the flip side of that, what am I actually making is what are you actually buying? What are you spending? What is your purchasing power when it comes to your business? That's the mindset you need to have. Because when it comes to my business, everything is on sale because it's always being discounted by my effective tax rate. So change your mindset a little bit on this stuff. So some of the changes or some of the things we need to be aware of, right? When it comes to doing our actual tax return, the beauty is on this left-hand side, our state and local taxes. So that's capped now at $10,000. The issue with that usually is that my coastal states, right? California's, my New Jersey's and New York's, you all tend to have higher property tax rates. In California tend to have an extremely high state tax rate, and so you're always going far beyond that $10,000 cap. But we have to be aware of it. The issue with a lot of changes and with tax code and when all this stuff is being done, you know, back in Washington, D.C., is that in reality, what happens is that the scale always has to balance. My scale always has to balance. Okay, so let's say I put out a new tax code, right? I still got to collect $3.4 trillion. And I still, as an IRS, only have a budget of about $11.2 billion to collect all that money. But if I give a bunch of deductions to this side and throw that scale out of balance, then I've got to take a bunch from this side to bring that scale back in balance. Because we always got to collect the same amount of money. It's not like all of a sudden the 3.4 trillion says, if we can only collect 2.7, we'll be just fine, right? It doesn't work that way. So everything always has to balance. So some of these things we just have to be aware of. Our personal exemptions, those things have been gone, right? So they took away the exemptions. So what did they do to balance the scale back out? They gave us the child tax credit to raise that thing back up to $2,000. And honestly, that was the last thing that was in play for the whole tax code to get passed, was to raise that amount. And tax credits, by the way, are always better than tax deductions because they're paying for our actual tax. The healthcare costs, right? We're at 10% of our adjusted gross income. Before those come into play, there's no more health insurance penalty. But the standard deduction is really the big one on this page because that got raised, right? Now this year for 2019, it's $24,400. And it's estimated that maybe about, I don't know, 71%, 72% of people across the US use the standard deduction rather than itemizing. So that's one of the reasons they raised it, right? Get rid of exemptions, give a little bit more for child tax credit, and let's raise our standard deduction, right? That's how we always keep these scales balanced. But if you were to ask me while this whole thing passed and why we have the tax code that we currently have is due to the corporate tax rates, right? That went from 35% down to 21%. Big reduction, and what they were trying to do basically is kind of even us out throughout the rest of the world. We're not the best, we're not the worst, we're kind of right in the middle now, right? And the objective of that is to bring jobs and stuff and keep those within the US. Now, is that going to work? I have no idea, right? These tax codes, they're passed, it's always a look back. So ask me in 5 years, did this work? And then we'll look back and say, yes, it worked. And what worked they keep, and what didn't work they change. And this is kind of how these things roll along. Because honestly, the tax code is just one enormous exercise in behavioral economics, right? I want you to do something, I'm going to give you incentives to do it. For example, I want you to have employees, I'm going to give you deductions for those employees. I want you to go buy a house, I'm going to give you a deduction for your interest in your property tax, right? That's how this kind of behavioral aspect works when it comes to our tax code. But what they did is they lowered the C corporations, they lowered their tax code. So what did they do for people like me or people like you, right? The LLCs, the S corps, the sole proprietors. What about us? Did our business tax rates change? No, not really. They came down a little bit, but this is what they did for us, right? The qualified business income deduction, often referred to as the QBID. So what this is saying, and this one is a beauty, if I am self-employed, okay, and let's say for my services, I charge $150,000. So I collect $150,000 for my services for the year. In order for me to provide those services, it costs me $50,000. I'm left with $100,000 worth of taxable income. The QBID will say, okay, out of that $100,000, I'm going to take a 20% reduction for 20 grand, and I'm only going to tax you on 80. Beautiful thing, absolute beautiful thing. So it gives us a 20% reduction in our self-employed income, right? Now, the interesting thing about this is it was new last year. There are lots of CPAs out there that missed it, right? Because the interesting thing is this deduction is taken in my personal tax return, but the identification of the type of income is done in my business tax return, right? So if you don't do it on the business side, you don't take it on the personal side. So my simple suggestion for you is that if you are self-employed and have self-employed income, go back to your 2018 tax return, go to page 2. It's roughly line 6 or 7. You'll see the qualified business income deduction. And if you have income and that line is blank, it simply means that whoever did your tax return missed, I don't know, a few check boxes as an identification of income. It's an easy thing to go get amended and get some of your money back, because we never want to overpay the IRS, but definitely review your tax return. Now, when it comes to real estate, right, especially real estate rentals, right, the interesting thing with the IRS is that they love to use words, and then they like to define those words. But here we have qualified. Qualified for IRS purposes means some type of income that has a self-employment tax associated with it. The beauty about rental real estate is that it does not. It's cheap income, right? That's why we all love it. I do it too. I'm a real estate person just like you. I have commercial real estate that I rent. I also do flips, right? So this qualified word really bothered me. And we were waiting for the IRS to come out and explain whether or not the rental side of things, if this would pertain to them. And we waited and we waited. I waited for 14 months. Can you believe that? 14 months for this answer. And finally, they came out with what was called a safe harbor rule for rental real estate. So specific, and only specific to this particular deduction. It does not make you a real estate professional, okay? So only specific to this deduction that you can qualify for the 20% through rental real estate or that passive income as long as you meet, well, certain criteria. I mean, this is the IRS after all, right? I mean, they're not just gonna hand you something without having a little bit of something on the back end, and the something on the back end of this one would be the qualifications. Now, mostly they're looking for 250 hours. Did you put in 250 hours towards your business? I mean, that's pretty easy. 250 hours, it's a few hours a week, right? So I would think most of you that are even on this webinar can do that. So I would just look, do I have income from my rental properties? If I do, see if I have that hour requirement, and then make sure you get a 20% reduction in that rental income to make sure you're not overpaying your taxes. Now let's get into some of the other things that we can do to try to limit the amount of income that we have. Home office deduction is one of them. Okay, there's two different ways of doing this. It used to be that we could only do the traditional home office deduction, which is kind of what people were, I don't know, used to, I guess. And but there is a back-end trap to that traditional home office deduction. Let's say that, I don't know, I live in Orange County, California. I went and I bought a 1,500 square foot home for $1 million, you know, and of that, 10% is used for my business, right? I have a 10% of the, or 150 square foot space within that home, 10% used for my business, $100,000. And I'm going to depreciate that $100,000 as part of my traditional home office deduction. Awesome, gives me a better write-off, right? Decreases my income. But here's the backdoor trap to the traditional home office deduction, is that when I sell my personal home, and I'm looking for this great exclusion, because the IRS wants you to sell, wants someone else to buy, they want you to go rebuy, right? Turning over of homes helps fuel the economy, so that's why they give us some of these incentives to do it. But when I sell my personal home and I'm looking for this $500,000 exclusion if I'm married, all that depreciation expense that I've been using on my personal home comes right back into income when I pay a bunch of tax on it. So the idea is if I use the traditional home office deduction, I have to be willing to take the back-end trap of paying tax on the depreciation when I sell my personal home. The other way of doing it, and they came out with a simplified home office deduction a few years back, is simply as it says, $5 per square foot, up to 300 square feet, $1,500 deduction. I don't have to list utilities or repairs or insurance or interest or taxes, nothing. It's simply based on the size of my office. I don't have to depreciate anything. It's a great way to grab $1,500 deduction and throw it into your tax return. So you have to weigh those two things for you personally. What do you need and what do you want? Is the traditional home office best for you, or simplified, something that you would rather do and not have to deal with depreciation recapture? Now, the one caveat I will say to this, and we'll move on, is that if you are renting, okay, if you don't own your home but you rent your primary residence, then the traditional home office is a beauty for you, right? Because then I'm taking part of my rent, my HOA, my utilities, and that becomes my home office deduction. So if you rent, look at the traditional home office, you're probably going to get a much better deduction. Cars, this is actually my favorite slide of the whole deck, simply because I love cars. I mean, I really, really love them. It's a problem for me. Just ask my wife. She'll tell you all about it. If I made, I don't know, $1,000 in a month, 800 of it would go towards a car payment. I'm an accountant. I can figure out how to live off of $200 a month, right? But I love them, and I want to write them off. I want to buy the most expensive car I can, get the biggest write-off I can, right? Because I like to interject and transfer personal into business use. So there are two ways of doing this. We can do it through an actual method, or we can do it through the IRS mileage method. Okay, and we got to choose one of the two. We can't flip-flop back and forth each year, just so you know. Once I choose the actual method for a particular vehicle, I'm stuck with that forever, just so you know. Okay, the actual method is just like it sounds. I'm going to depreciate the car, and I'm going to look at all of my actual costs. So I'm going to combine my gas and my insurance, my repairs, my maintenance, my tires, the cool carbon fiber spoiler you put on the back, the smelly little trees you put in your car, you know, all those things. I'm going to total up all those expenses. And then I'm going to look how I used my car. So let's say I drove it 10,000 miles total for the year, 5,000 miles for the business. That gives me 50%. So I'm going to grab that 50% and I'm going to use that on all those expenses, and 50% of all those costs becomes my deduction. Okay, so it's still, even when I'm using the actual method, depends on how I use the car. It always depends on how I use the car. Now the IRS mileage method is much simpler. I just look at, if I were to take that same example, I grab those 5,000 miles, times it by the IRS rate, it's currently 57.5 cents, boom, that's my deduction, right? But in both cases, you need to keep a mileage log. Now, I already know you do. Like, I can look at you, I can know every single person that ever watches this webinar. I know you keep a mileage log. I know it. But if you don't, you know, I would say start, do something, right? There are apps, there are all kinds of ways that you can try to track your mileage, but just try to do something. Even if you kept it for 3 months, then extrapolated it over the rest of the year, the IRS will still accept that. Okay, so just do the best you can to keep a mileage log. It becomes really important when we're trying to defend you and the expenses that you have. Okay, business expense classification, section 162, trade or business expenses. This is where I live and breathe. Okay, because this is the ordinary and necessary expenses for my business. And what is ordinary and necessary? Well, it becomes an argument a little bit. I mean, I have a 9-year-old daughter who thinks it's ordinary and necessary to only shower twice a week. I disagree with that, okay? That is neither ordinary or necessary to only do it twice a week, okay? So we argue about this all the time, but that is what happens with this code section. This is why we have tax court, because we argue about this all the time. So when it comes to your business, this is what I would tell you. Look at what it took for you to make $1. Look at what it took for you to make $1. All those expenses, go through my credit card receipts, my bank statements, the checks I wrote, the cash I spent. How were you spending money, and how did that go into your ability to make $1? For how you work your business, for how you deal with your activity, right? How did you do it? That is probably what is ordinary and necessary for you, okay? So just look at what it took for you to make $1. So with real estate taxation, I just want you to remember 2 things. There are 2 different paths that you can walk down when it comes to real estate taxation. The for rent side and the for sale side. The for rent side is the investor side. Typically when people think of real estate, you're thinking about the for rent side. Okay, that's where I'm going to go buy a property, maybe I rehab a little bit of it, put some renters in there, I'm going to make some rental income, I'm going to depreciate the property. When I sell the property, it's capital gains. Right? I can 1031 exchange that property. The money that I make is not subject to self-employment taxes. That's the investor side of real estate. The for sale side is the dealer side of real estate. Okay, that is the flipper. So when I buy a property, it's not even a property, it's inventory. You have to think of this business much like you would do a retail company, right? I'm going to buy a product and then I'm going to resell it for a margin or for a gain. Okay, so I'm going to buy real estate, it's my property, right? It's my inventory. I'm going to rehab it and I'm going to put a bunch of money into it and then I'm going to sell it for a gain, and that's ordinary income. It's not capital gains. I don't 1031 exchange, and the money that I make is subject to self-employment taxes. So they are very, very, very different. And you need to understand when you go into a property and when you are evaluating a property, which side or which path are you going to walk down? Because the landscape will change from a tax perspective. And if I'm going to do some planning with you, then I need to know which path you're walking down with a specific property. So just be aware of that not all real estate taxation is the same. And it's important for you to do tax planning with someone who understands real estate, okay, whoever that might be, Okay, one thing I like to talk about is optimizing your business structure, because you sit in the center. We want to go out and buy real estate and deal in the real estate game, but we have all these different people we have to deal with, right? So we have revenue coming in, we have expenses going out, we purchase properties, we depreciate them, sometimes we sell them. We have retirement plans that we may want to defer money into. We got to deal with the IRS, sometimes we got to deal with state. So we want to optimize your business structure. So you want to look at what is the vehicle, the entity I'm using, right? How am I structuring my finances and my expenses? And then how am I utilizing retirement plans to maybe defer some of my tax? So those are my 3 areas when I want to optimize my business: my entity, my operations, and my retirement plans. So evaluate those on your end, see how you kind of score, I guess, you come up with. And then maybe sit down with someone and start talking about where you can gain some advantages within those 3 various different areas. Okay, because if you want to reduce taxes, there's 3 basic rules of doing it. Essentially, I need to defer it, spend it, or connect it. Right? And let me tell you what I mean by that. Defer it. That's my 401k plan. So if I have some income that's coming in, right? Let's say it's all passive, for example, right? Well, it's hard for me to contribute to a retirement plan when I only have passive income. However, I do have the option of creating a management company that oversees my operations, that creates income that I can then convert and contribute to a 401k plan, right? Thereby deferring and pushing tax out and reducing the taxes that I have to pay now. So defer it refers to my 401k plans. Spend it. Yeah, spending money reduces your taxes. Why? Because I'm creating expenses, right? I'm reducing my taxable income. So if you remember, when we had the picture of all the various IRS tax rates, right? and you were looking at, okay, if I want to go buy that $1,400 iPhone, I'm really only spending $1,000, right? Because I'm spending money, creating an expense, reducing the amount of tax that I have. So towards the end of the year, specifically, we really get into planning. Is it necessary for you to buy some equipment for your business? Do you have some advertising or marketing you want to spend on, right? Towards the end of the year. Maybe you made too much money. So how can we look at spending some of those that are going to benefit us as we roll into the new year, thereby reducing the taxes that we owe during the current year? So spending it is also a rule for reducing taxes. The final one is connecting it. What are you connecting it to? My personal side. If you were to look at your personal side and how you spend money, okay, so let's say in my house, I have the internet. I pay for the internet, right? Let's say it costs me $600 a year. Regardless of whether I'm self-employed or not, I'm still spending that $600 a year for internet, right? But if I can now connect the internet to my business on how I use it, I am now grabbing personal expenses, connecting it to the business, and now I am writing it off, right? So what within your personal finances or how you spend your money can I now connect to my business? Cars with another one, right? I do that one. How can I connect the car that I'm going to have regardless of my business? Connect it and start writing it off. So just look at those three as kind of an lying principle of trying to reduce my taxes. Deferring it, spending it, or connecting it. Because in the end, what I want you to do is I want you to be you, okay? I want you to go make tons of money in real estate. I want you to spend your time doing real estate. I want you to lead tax code and compliance with the rules and the laws and how to interconnect all those things to people like me, because that's all we do, right? I can remember when we first started the firm, this was many moons ago, I won't completely date myself, but I thought, I'm an accountant, I'm cheap by nature, except for cars, but I'm cheap by nature, right? So I don't want to spend any money. So when it came to buying a computer for my business, I thought, you know what, man, I'm brilliant. I can build those things. I'm smart enough to do that. I'll save $250 a computer rather than buying it from Dell. I'm going to buy all the individual components. I'm going to build it out. So that's what I did, right? Built a bunch of computers, which led me to building a network, which led me to doing my own phone system, which led me to trying to build my own website, which was a disaster, by the way, right? So it was me doing all these things that were outside of what I was good at, what I was trained to do, and how I made my money, which was tax compliance, tax planning, right? So we go in the busy season, computer breaks down. Who do they call? Hey, Joel, come over here, right? Fix this computer for me. So I'm there spending 3 hours trying to fix a computer. What am I not doing during those 3 hours? I'm not doing any tax compliance, any tax returns, any tax planning. So I'm not billing anyone anything. And it turns out that $250 that I thought I saved building those computers, and that costed me an enormous amount of money, right? So what I want to tell you is to build your team. Build out your team. Decide what your team looks like. Do what you do to make money, and then build out a team to help you do exactly that. So now I have my own IT department that deals with computers. The phone guys deal with my phone. I have legal that deals with all my legal issues. I have website people that deal with all my website stuff. I don't want to deal with any of that. I want to focus on one thing, and that's the one thing that makes me money, right? So I built the team around me. I would suggest you do the same thing for you, because our IRS audit environment has changed. It's changed over the years. It used to be that we would all get audited face to face. That actually happens relatively infrequently now, because all the IRS has switched to this IRS letter environment. Because what they have found is that when it's face to face, it's about 91% of the time that there are some changes. 91%, that's a lot, it's almost always, right? There are some changes to the tax return. When they send you letter audits, they don't need an agent on the other end. No one's meeting face to face. It costs 50 cents to mail something to you. 89% of the time, still changes. So the cost effectiveness of these letters is substantial. Over 70% of all audits are now done by letter. So they're just pumping these things out. Because let's be honest, what happens if you get a letter in the mail that says, hey, you owe $800 to the IRS? Even if you don't, what are you going to do? Again, this is an exercise in behavioral economics. Most people, they don't want to deal with the IRS because, one, it makes them nervous. I don't blame them. IRS is a bit of a bully, right? They don't know what to do. They have too much going on in their life to take the time to try to figure it out, so they simply just pay the $800 and get the monkey off their back. IRS knows the propensity for you to do that, right? That's why they have switched to this method, because scale always has to balance. They still got to be able to collect the same amount of money or more, and their budget seems to go down a little bit every year, which means they got to be smarter and figure out ways of collecting money, and this is how they did it. Because the IRS gets tons and tons of information on you, tons. Your employer sends information. They know how much you make and how much you withheld. Banks send information on you on interest and interest earned and interest that you paid for mortgages, and if you made stock trades, that all gets sent to them. Broker statements, and they can match all that stuff up. They can match all kinds of things up within your tax return. They find any kind of discrepancy, boom, send you a letter. Have you ever thought about why you put your occupation on a tax return? I mean, does it really matter? I mean, let's say I was a doctor, for example. I mean, they already get my W-2 if I was employed by a hospital. They know exactly what I make, what I withheld. Why does it matter if I put doctor in there? What they're trying to do is they're trying to lump categories together, look for outliers. Those outliers are people that they can go after, right? So in a simple audit strategy, I would simply say change your occupation to something as meaningful and direct as manager, administration, sales, real estate, right? So let's be a little more generic. Let's not help out the IRS. It's just a personal view. It's something I like to do with all of my clients. But who do you think they're interested in auditing? Who's the club that they like to? Yeah, I know most people will say, if you make over $1 million, yeah, that's true. They look at those people because their tax rates are so high. So any little change they can find means they collect a lot of money. But they're also interested in simply the self-employed people, because what you're reporting to the IRS is saying, hey, this is the money that I made, and hey, this is how I spent my money, and this is the tax that I owe. There's very little third-party verification under that scenario, so they always are, shall we say, distrusting of people, you know? So they like to audit the people who are self-employed. And lots of times it's even under that $100,000 mark, because they figure you don't have the help, you don't deal with the IRS, it's an easy money grab. Again, you get that $1,200 letter in the mail, you're just gonna pay it, you don't wanna deal with it, right? But here's a picture of an actual audit letter that some people who became our clients brought into us one day, and they were very nervous. You can see on the very bottom right-hand side, it says, hey, I owe IRS, right? $62,000, that's gonna ruin their day, it's gonna ruin my day when you come in. It's a lot of money to owe the IRS. But if you look on the second line down, Schedule D capital gains, what's the tax on the $481,000 loss? Big fat zero. What's the tax on a $245,000 loss? Another big fat zero. But when the computer sends that over, fifth grade math, right? The reduction in negative equals a positive. So you have $236,000 worth of fictitious income because you had a reduction in loss. The computer system just takes that all the way down and says, hey, you owe us $62,000. That's why I say these letters aren't always right. We got this cleared up. They didn't pay it. They didn't owe it, right? So I would always suggest, and I don't care how much the letter says you owe, even if it's $150, make sure you go through it and make sure that you sit down with someone and only pay it if you actually owe it, okay? Only pay it if you actually owe it. So let's go through some audit tips. Just know that if the IRS suspects it's more fun, and honestly, real estate is fun. Like when you go to a closing and you sign on the dotted line when you buy a house, I mean, there is an endorphin rush that I just love, right? But if they think you're having fun, they want to disallow it. Nothing that's fun should ever be deductible, okay? What that simply says that if you enjoy it more, like cars, that just simply says my support for that deduction really needs to be solid. Support will always defend what you're doing. So if you're nervous about a tax return, just make sure you have the proper support. If you have the proper support, there's nothing to worry about. Okay, so looking at your auto expenses, anything that's depreciable, large dollar assets, travel's another big one, meals if they're too pricey or expensive, just make sure that you have the documentation behind those expenses, right? To ensure that you'll be able to keep that deduction. Also, let's use technology to our advantage. There are all kinds of apps that we can use and software to help us categorize and keep track of the money that we're spending. TaxBot's a great one to use if we just want an app that's easy to track money. That also tracks mileage. MileIQ also tracks mileage. My credit card even has an app that my Amex business card, when I go out and I buy something, it'll pop up within seconds of me swiping my card, and I can simply take a picture of the receipt. Boom, it's logged. Amex is kind enough to keep it for the 7 years that I need to keep my tax returns. I mean, it's a beautiful system that I can just throw away the paper. I don't want to keep a bunch of paper, right? So use software to our advantage. Use Excel, QuickBooks, use something, because if you don't keep track of the money and how you spend it, how am I supposed to do a good tax return for you? We often say garbage in, garbage out is what we're looking at, right? So if you give me a bunch of garbage to do your tax return with, it's going to be a garbage tax return. So we have to have some responsibility over our records. Not that I want to make any of you accountants, but just be aware. Okay, use technology to your advantage so you understand how much you're spending. I mean, I am very detailed when I do a flip. I want to know every little dollar that I spend, because I'm trying to capture every little dollar that I spend to make sure I'm only going to pay the IRS on what I've actually made, right? And unless I'm doing a good job in tracking that, it's very easy, very, very easy to overpay. Okay, so let me just give you a couple quick takeaways, and then we'll go to some questions. So if you post your questions, as soon as this is done, I'll go through for the time that we have, okay? So first, let's be aware of our tax environment, right? Some things have changed as we interact with properties, as our revenue expenses. We got to understand how that affects our financial decisions and the tax that we may owe, okay? So we need to be aware of our tax environment. Like I said, build your team around you, which means creating strategic partnerships with various people. It can be from general contractors to real estate agents to your accountant to your lawyer, all those people. Have your team. And then understand how taxes affect your business. What am I really making? But on the flip side, what am I really spending? Okay, fine. Second, let's use some common sense. Okay, don't always look for advice from the wrong sources. Okay, you know, Uncle Joe that comes over for dinner once a month, you know, steals all your leftovers, may not be the best person to get your tax advice from, right? Make sure you're going to good sources to get good information, proper information for your particular scenario. And then I would also say that it really does help if you're choosing a tax preparer to choose someone that understands real estate and understands what it is that you're doing. It will make your life a whole lot easier. And finally, since we're in business, right? All of us are in business. We got to act like it, which means taking responsibility for that business. You will come out way ahead, right? Way ahead if you are looking at it from a financial perspective. I mean, oftentimes taxes are death by 1,000 paper cuts, right? It's all those little things that we miss that add up to us paying more and more in tax. Okay, so let's be smart. Let's reduce what we owe by putting in proper financial decisions. So finally, if you would like to talk to us and go through a strategy session, we'd love to talk to you. We'll, if you schedule anything, we have some books and some things for you that we'll throw at you as kind of an incentive. But we do want to help, even if, you know, we get on the phone for a few minutes and give you a couple ideas particular to your scenario. The problem with tax is that if you were to ask me a tax question, my first response is always going to be, well, it depends, right? It depends. It depends on your situation, how you're spending money, what you're buying, what your activity is. Are you flipping something? Are you renting something? How many rentals do you have? How many flips do you do in a year? What's the strategy we want to do to maybe create management companies and push income around and, you know, all these things. It's going to depend on your particular scenario. So if you want to talk to us, we'd love to talk to you and sit down and go through and see if we can help you out, even with a 20-minute conversation. So let me turn this back over, and maybe we'll go through some of your questions. And as just a side note, everyone be safe out there.
Awesome, awesome. So we have a couple of questions. First one is, will the COVID-19 payment affect any tax returns for the current 2020 year?
Ooh, good question. So, okay, so first thing, we got to remember it is the IRS, right? That's like our baseline information. This is the IRS. So what they're saying at the moment is that the $1,200 payment will not be taxable income. Okay, so they're not going to tax the $1,200 payment. However, if you want my opinion, they could use that as a form of tax credits, or in order to reduce tax credits, or you may have to repay that back depending on how much money you make in 2020. So if you look at the income limit, so I make over $200,000, right? That excludes me from the payment at all from 2018 to 2019. Let's say I was at $100,000 for those 2 years. I get the $1,200 payment, and then 2020 becomes a banner year. I make $300,000. My suggestion is more than likely the IRS will figure out a way to have you repay that money. But other than that scenario, it's not going to be taxable income. And beyond that, we just kind of got to sit back and wait to see what they say.
Okay. And the next, and looks like last question right now, is how long do you keep the records?
Okay, that's a great question. So typically the IRS can audit back to 3 years. Okay, so we always got to have 3 years handy. The problem is if there are big enough discrepancies between what the IRS says should have been reported and what you did report to 25%, they can go back 7 years. So the rule of thumb is always 7 years. And now I'm going to throw a little pitch in there for you. Anytime I buy a real estate property that I am renting, so let's say I buy one in 2020, I need to keep my tax records for as long as I own, or at least that 2020, until I sell the property plus 7. Because the initial year when I buy it, it establishes my depreciation rates, and so I always need to have that on hand. So I need to keep that 2020 tax return for as long as I own that property, and then when I sell it, let's say 2025, so after 2025, I keep it for 7 years. That's the one caveat. But as a general rule, it's 7 years.
Awesome, awesome. Well, if we don't have any more questions, just a quick reminder to everybody, we will be sending this out in email, a link to the recording so you can listen to it. Again, if you want to get some more information, or if you missed something and taken notes, you can go back and listen to it and make sure you get everything. Thank you so much, Joel, for doing this today, and thank you everybody for attending, and keep a lookout for our next webinar.
Thanks for having me. Appreciate it.